just acknowledging, their gifts, their roles that they play here with Can Do, making sure everything runs smoothly. So welcome. Happy Tuesday, everybody. My name is Michelle. I'm joining from Amiskwaciwâskahikan, Edmonton, Alberta. It's beautiful weather out here today. Not so much the story last January, but here in 2023, we got a really good day. The sun really hasn't shone too much in January, and you know what? I'm okay with that as long as we can, go for nice walks in the winter weather without getting frostbite. So I hope wherever you're joining from, you're able to take a moment. I think it's always important to take that moment for ourselves, for that connection, to the beautiful land Creator has given to us. So on that note, let's just take a moment, press pause, take a deep breath, maybe close the eyes, maybe feel your heartbeat for a moment, and just give thanks. The breath that has been given to us, may we extend that gratitude back to Creator. And give thanks for the gift of this day, the gift of breath in our lungs. I always give thanks for the gift of water. Water replenishes us. It restores us. I think it's one of Creator's best gifts. So there's so many gifts that we can give thanks for. And so I hope you are able to extend some of that to Creator in this moment. So you're joining us here with Can Do Tuesday, Links to Learning. We only have a couple months left together. So I hope you join us on these Tuesdays, and then there's Innovate BC on Wednesdays, and take in all of this good knowledge that's been given to us. So we're glad and honored that you're here. Also, I always think it's important to make the note that your feedback, your evaluation, because you'll be sent a link at the end of today's webinar, that if you send in your evaluation of today's webinar, first and foremost, it is so appreciative. Your voice is so important, but also your name will be entered into a draw that we do at the end of the month. So please, please, please fill out that evaluation link. All right. Well, let's get to business, shall we? Let's get to why you've joined today's webinar. And the topic is how to project your finances for funding. So money is really, really integral to what we do in our organizations and our communities, to do the projects, to do the good work that needs to be done. So I think today's conversation is going to be a good one. So welcome, Laura. She's joining us all the way. It's New Brunswick out east. She's joining us. It's already dark there. They're probably 2 hours ahead of me anyways here in Alberta. So we're glad you're here. So she is a Mi'kmaq First Nation with a background in mainly accounting roles, banking, and economic development. And after graduating from the University of New Brunswick, Fredericton in 2017, with concentrations in both accounting and human resources management, she is currently working at the market access. Wait a minute. Let me rephrase that. She's currently working as the Market Access Officer at the Joint Economic Development Initiative, and the acronym for that is JEDI, located in the traditional unceded territory. Oh, goodness, we're going to give it a try. The Wolas. Can you help me out, Laura? I was going to try and I failed.
It's Woolastoq Kiek. But most
Thank
people
you. Oh, thank you. Thank you. So with her role at JEDI, she oversees the incubator and accelerator programs, assists in advisory services, and the planning and execution of various building workshops with existing Indigenous entrepreneurs and business owners in all industries. Holy, her hands are full. And here she is joining us this afternoon. I believe there will be opportunity at the end for any questions or comments that you might have during today's conversation. you know, that chat box at the bottom, use it. We love to hear you throughout. So if you have comments, questions throughout, I will be making note and we'll be sure to get those answered. Also, you know, use those reaction buttons too. If you like what you hear, make sure you let us know. So welcome, Laura. Thank you for being with us. And we're looking forward to your webinar today. So I'm going to pass this virtual mic off to you.
Wonderful. Thank you so much, Michelle. I don't think your full name's on, you're missing an I, but I'm assuming it's Michelle. So thank you. So hi, everyone. I'm just going to share my screen. So this is actually my second Links to Learning. Actually, this was a follow-up to the first one I did. So I actually did, sorry, I'm just going to close this. I actually did one for the business planning. So really kind of going through the different sections of it. So I got a follow-up from Can Do to actually do more of an emphasis on the financial projections kind of forecasting section of the business plan. So I'm actually going to keep this high level given the fact that I literally only have like 45 minutes. So I'm going to try to go through various parts of, I guess, the financials that are part of that section and the whole forecasting section of that. And obviously other things to keep in mind of when you're trying to go to lenders. So I'm just going to hide. I think that's there. Nope, that's not that. There we go. Are you guys still seeing everything? I can't see you. Yes, no?
We're good. You have it up.
It's good,
Okay.
Laura.
Oh, awesome. Thank you guys. I can't see you. So if there's any questions, honestly, I think the best way to go about this is if you have it fresh in your mind, just ask away. And I don't mind, like, just interrupt me whenever you want to, I guess, if there's questions, just because there's a lot of information kind of I'm going to be throwing at you guys. So it's honestly the best, I think, method to go when you kind of get the questions instead of waiting later, because you're gonna be like, why did I ask that question? Because it's better to keep it live and informal. Honestly, it's the best way to kind of take in new knowledge. I actually did the first business plan, I guess, workshop webinar with Links to Learning under JEDI. I am actually owner of Bigabee Consulting. Actually, that was a nickname my Giju, my mother, gave me growing up. Translation, it's Big Baby, which is really funny because I cried a lot. So a little joke to start off, I guess, the presentation on, I guess, the background of my consulting business. I wanted to keep it close to home and something special, but now you guys know what it means. So before we begin, I'm actually going to take a moment to acknowledge that I'm located on the traditional unceded territory of the Wolastoqiyik, Maliseet people. This territory and all of New Brunswick are covered by the treaties of peace and friendship, which the Wolastoq, Mi'kmaq, and Passamaquoddy people first signed with the British Crown in 1725. The treaties did not deal with the surrender of lands and resources, but in fact recognized the Wolastoq, Mi'kmaq, and Passamaquoddy title and established the rules for what has to be an ongoing relationship between nations. So, like I mentioned earlier, I actually did the first Links to Learning on the business plan. And although typically the last section of building a business plan, the financial plan and projections is one of the most important analysis within the plan that helps you define your business's financial situation. So basically it's your way to be like, this is how profitable I am to potential funders, for grants, potentially as well. They might ask you for a little bit more background on how you're planning to make money. And really at the end of the day, it helps you understand how you're doing in your business, how you plan for the future, the unexpected. And basically this section outlines any business financial information that you can estimate, know where to start, or like how to run your business. So you could do it right before you actually start a business completely, or if you're already operating, it's a nice way to know kind of like what are the busy months that I'm doing my when running my business, basically, or when is the slow time? When do I have to maybe potentially ask more money from lenders if it's too busy and I have to make more product to sell potentially? So forecasting, although it's not perfect to a T, it gets better over time. And I think with the intention of getting better over time, it'll get better. But at the end of the day, I'm going to keep it simple for you guys and really just kind of explain what goes into it and how to do it. So this includes, so doing a forecast, it includes current sales and expected sales that you plan to make, as well as costs. So usually it's within 3 to 5 years that they typically ask for you to kind of project. Basically, you want to see how your business is growing and whether it's able to sustain itself in the long run. So it's really advisable to actually go to an accountant for these things. But if you want to learn it and do it yourself, this is a nice, quick and easier way to do it. But again, this could be really, really complex stuff. Just want to let you guys know. But I'm not a professional accountant. I just have some background on accounting, and I've been in accounting roles. Never actually got my designation. So I have the knowledge, I'm going to share it. So yeah, just going to jump right in. I have my notes in front of me because my presentation view is acting up a little bit. So thankfully, Michelle gave me kind of a background. She mentioned I was Mi'kmaq, but I'm from Listowitch. So I don't know if many people know that, but it's around the Gespegawagi, beautiful Gespegawagi. So around kind of like south of Quebec and north of New Brunswick. We're like right in the border town of like New Brunswick. So we're right between provinces. So I won't go too much into my background because again, Michelle kind of gave a really nice overview earlier. So today I'm going to cover a simple example, like I mentioned, on how to project your finances for the purposes of learning how to do it. Also the benefits and reasons why you may want to do a financial projection. I already mentioned that. You guys know I am not a professional, so just keep that in mind, that you're just be like, oh, Laura told me to do this, but I'm not an accountant, so I'm just telling you what I typically do with clients when they ask for some projections. So I honestly try to keep it simple as possible, but you can get complex if you want to. So essentially the importance of it. So there's various reasons why it's important to know where you are at today, whether you're spending too much on banking fees, for example, or administrative costs or mileage, depending on how your business is run. You want to set goals for yourself and your business. So understanding how much is going into the cost of operating your business, even just being able to know the cost of it in the next year or even 2 will help you better prepare yourself for potential changes or abrupt situations where one of your machinery breaks down, for example, then oh, I have to spend an extra potential $10,000 in the next year. At least you know what to prepare for, access funding, or start putting money aside from business income or personal income. Like I mentioned, it's ultimately the last section of a business plan. The financial projections helps lenders understand how realistic you are with your financial situation compared to competitors. It's typically the second section that they look for after the executive summary, which basically is a summarization of your whole business plan on like 1 page. So a lot of the times lenders don't really go through each page. I'm going to be honest with you. My partner actually works as a commercial banker, and he has told me they don't have time to go through like 25 pages. So a lot of the time they actually go straight to the executive summary or the financial projections, and any follow-up questions in regards to like cash flows and stuff, but I'll get into that later. So basically, the more realistic you are with your financial situation, the more likely they are to trust lending money to you potentially for your business. So where do we start? So if you're an existing business, you should already have accumulated, so kind of started selling stuff, started buying stuff for your business. So you what they call transactions. So what I have here is historical transactions. So that's really like you have the data there of how much it actually costs to do your business. Whether it be invoices you build out, like I mentioned, for services your business completed, or the sale of products your business created. So it could be service, product, whatever you are, you put money into it, you start getting money for it. It's also important to understand how much you've already contributed to the business. So before you even started making money, you obviously have to invest in your business, put your own money aside, and knowing how much you already put money aside or into your business is really important as well, because I'll explain where that actually pulls in later. It's also important to understand how much you've already contributed. Yeah, like I mentioned, oh, reading again. Sorry, guys. So what they call, I guess, in accounting lingo, this is like capital assets, for example. So like inventory, for example, you didn't sell it yet, but you're planning to sell it. Equipment, like I mentioned earlier, could be land, maybe off reserve or on reserve, doesn't matter. Could be buildings, could, again, on reserve, off reserve, does not matter. Office equipment, so a computer, for example, a desk, a chair, so everything you put into your day-to-day, what you plan to use solely, like only for your business, that's considered capital assets. And you should typically, have some records in hand, whether you have put them into an accounting system or someone did it for you, or you've been keeping track of them on like an Excel spreadsheet, or even a handwritten ledger books. I don't know if you've ever seen those, but it's real old school. It's when people put their debits and credits on this big binder looking thing. I've seen it all. But essentially, if you haven't done any of that, which is fine, I think it's probably a good time. Maybe this will be your calling to do it now, but just start sorting your things by, I guess, function, which I'll go into that later. You already have some things in mind. You're like, oh yeah, I bought a laptop, I bought a keyboard, I bought a chair. So right away, you're kind of categorizing each of these transactions, whether it being something, the cost of actually the product you're creating, or it's the cost that you're putting into, like I said, capital assets for your day-to-day. So the things about costs, if it's things that you plan to sell later, that goes in a completely different section, but I'm going to show you exactly what I mean right now. We're just talking at this point. So if you're a brand new business though, and you're seeking funding for startup, you're expected to do a lot more research on some potential costs that you can guess that you probably will start seeing. So it could be, again, the day-to-day stuff, or any like equipment that you need to start up and actually start doing your business. So a lot of times, again, you have to do your research. So that's like, again, getting quotes from, I don't know, construction businesses to create this building, getting quotes on business insurance, getting quotes on a vehicle that you might be needing only for your business. Just kind of get an idea of like, okay, what do I need to operate this business? And then you could start almost categorizing those cost items, I guess. Okay, so there's a few different reports that are typically part of this section. Again, right down to the financial plan, financial forecasting. So they're usually, you include 3 of these things. So essentially, the first one is the income statement as listed. So that report actually helps outline your revenues, the money that's coming in from your business, and the expenses that costs to kind of build that revenue, whether it be, again, day-to-day stuff or the actual cost to create the product, for example. So typically, when you're doing a forecasting, which I'll show you an example in a moment, it's on a monthly basis. So it's not like an annual amount typically, although you can make an income statement that's a sum of the whole year. But what lenders typically want to see, or people that provide grants for entrepreneurs, they want to see the activity, I guess, like how is it in January compared to March? What are the costs that you're incurring? Potentially, like you're more busier in the fall, so it's not that much revenue coming in August, for example, or July. So a lot of the times the funders, the lenders want to see the variance, I guess, like the differences between the months. And obviously the columns, or I guess, like I'll show you in a moment, following that sum of the whole months that I just mentioned, then you'll have your projections there typically. The other statement that I have listed here is the balance sheet statement. So this is, again, I keep mentioning the capital assets, the stuff that you need to invest into your business. This is where those costs actually stay on, I guess, forever, because that's the value of your business. So the balance sheet actually shows lenders how much money you put into the business, whether it be your own personal finances that you put into it, or the money that you generated over time from the business. Or the fancy word for that is retained earnings, but it's basically the money that you kept from past years that you didn't pocket, like keep in your pocket basically. So this is outside of like salaries, for example. This is the money that that you could potentially take out of the business, what they call like dividends and stuff like that, but that's a whole other topic to get into. So basically, if you don't have any historical, like I mentioned earlier, so any past data on how much you've invested, so you actually didn't put any money into it yet, you're a brand new startup, you can actually just lay out the startup costs here. So again, like, what do I need to start my business? This is how much it's going to cost for this equipment. This is how much it's going to cost for like the building, for example. So just really outlining the ask, I guess, from the funders potentially. So basically cash needed, again, like equipment, building, inventory, etc. And lastly, the fund cash flow statement. So the statement simply just really shows the cash going in and out of your business. So it's a statement that shows how the business owner is using cash, like how you're using your fluid, what's in the bank money. So basically this is outside of loans used for your day-to-day operations. So it's really, really important for lenders to understand how you're managing the money that you have. Are you short certain months? What are you going to do when you're short certain months? Like you have to call up your banker and be like, I need 15K to cover all of these costs over the next 2 weeks. So cash flow statements help you as a manager of your business, your company, your organization, be prepared of I guess the expected money that might be dipping you in the negatives, but we don't want that. So that's why it's really important to manage your cash in a really like proactive way as much as you can, because honestly no one's perfect when it comes to cash flow, and it's a kind of thing that, like, even if you go into the negative, like, don't be so hard on yourself. You just have to be prepared and making sure that you have, I guess, a backup, like having a good relationship with your banker potentially, because this has happened before in the past. Even with my partner, he had calls where like emergency, I need 15K, and he has a good relationship with these clients, so they're able to kind of push through these loans. So we don't want that. Those are the worst case scenarios. So being really smart with your cash is important when it comes to operating your business. Okay, so income statement, yay. So I'm actually going to go through each of the statements I mentioned, and I'll actually kind of show you the different ratios that even loan officers, so people that are looking at your application, that might do. So I actually made a nice example here, and I'll go through each section. I have to jump between two. So I'm gonna have fun with this thing here. I might just put that in the bottom so it's not in the front. Okay, sorry about that. So I actually have this nice looking thing here. And it looks really scary, and I promise it's not that scary. This one shows ratios. So I'm going to get into what each section is. So I don't know how familiar you guys are with income statements, so I'll just kind of give you a nice little overview of everything. Like I mentioned, it's month to month. So typically funders like to see the month to month, but a lot of the times when you're doing your own statements, you'll have the year, only the year. So again, this is only for the purposes of forecasting, whether it be for yourself or for funding opportunities. But essentially, like I mentioned, this breaks down the revenues and the expenditures. So the stuff that you bring in from your business and the stuff that goes out to get that money. So I just made up numbers just for purposes of exampling how it would look. So January made $15,000. And this cost of goods sold is essentially what I kept saying earlier on, the costs associated with creating the product you're selling. So say there was meals involved with you getting to a certain place to sell your product. You put it here, typically. Any merchandising inventory that you need to create inventory would typically go here. and this actually, I'll get into the gross margin of what that is later. Expenditures, so anything below this line, this is all operating. So this is stuff that is honestly like what the costs of even just existing as a business. So this is your salary. So you could put your salaries in here, or if you have employees, you put them here. Sales tax, if you're paying or receiving sales tax. Excuse me. Travel. So if you're traveling for conferences, for example, repairs and maintenance. So that's anything where like if something broke down, this is where you would put it. And again, like you start noticing that not all of them have amounts in there, because these are costs that, what you probably heard this before, but get written off. So a little background on writing off things. When you write something off, you're actually just putting it on this section. If you're not writing it off, you're actually putting it on your balance sheet. So it's different relationships. So obviously repairs and maintenance, you wouldn't put that on your balance sheet. So that's something you can write off in the period. So telephone, like I mentioned, I didn't mention that, but telephone is kind of like something you expect to happen every month. So again, like I mentioned, this section is to operate your business. All right, so now that I kind of gave you a little background and actually gave you an example of what I've been talking about in the last like 15 minutes, I'll give you a little background on gross margin. So I tried to highlight where it grabs, but essentially it's sales revenue. So revenue minus the cost of sales, so these, and that gives you the gross margin. So actually yeah, 85%. So I actually just took that amount and divided by that to get it a percentage. So 85% means it's good. Now, give a background. Every dollar spent, the business keeps 85 cents. So that's basically what that means. So now that 85%, I have 85% to cover all of this. So that's, to lenders, they're like, oh, okay, 85% is really good, because they actually have a lot to play with in regards to like paying off whatever the operating expenses is depending on the month or the year. And the net profit, I know I would the net profit would be the income less the cost of sales, less operating expenses. So that's literally just grabbing that and minusing this. And then it basically, where is it grabbing from? So basically that, again, like I told you, it just makes it into a percentage. So it makes more sense in that way. So now I'm at 13%. So basically a little background of what's considered low and high to lenders. 5% is considered low. So that's kind of, you're walking away with 13% profit out of everything. All the work that you did, you're walking away with 13%. That's what that means. So 10% is healthy and 20% is really high margin. So you're walking away with a lot of profit, basically. So if I had like a 50% profit margin, means I'm like, oh my God, I have like no operating expenses. I'm just pocketing all this cash, which is awesome. So a little background on kind of where that all comes from. And I'm going to provide actually this is one thing I forgot to include with the presentation. So I'm going to send this to Elise so she can actually share it with you guys. Again, if you have any questions, ask now, because this could be a lot to take in. And I'm trying to simplify it the best I can.
Hey, Laura, there is a question in the chat box from Dan. So why would a business owner take a dividend payment versus a regular pay salary?
That's greediness. So these are people that I guess they're really, if you have a lot of investors, I think that's the most time you'd ever see that. So say you start taking in money or start selling part of your business. So you're not 100% indigenous owned anymore. You're maybe 51. So that other 49% is valued to share other shareholders or other people that have ownership in your company. So they can actually pull out their investment. So that's essentially when you would see that. So if it's just you, it doesn't make much sense to take it out if it's just you. Again, this is when it's like your business went like huge enough to the point where you're like, I can't sustain it myself. I need more part owners to help me keep going, basically. So that's like a later kind of thing where you're like, okay, I'm growing so much, I need help. So a lot of the times you see dividend payments when shareholders want to start taking out money from it. Whether I can do a whole different links of learning on this, but essentially, in short, it's when there's an agreement with people that own part of your business and they get like maybe 2% a year. And that's where typically you would see that coming out of the business. And that they actually, as dividend tax lower than salary. I'm trying to remember my tax my tax side. I don't think so. I think they're actually high. No, the CRA doesn't like it when that happens, so they usually tax it pretty high. But then that gets into a whole other conversation where investors typically move money around in like trusts and stuff like that, where they have separate entities almost hold this wealth for them. Really gross topic. I don't want to get into that one too much, but yes, they get taxed more. So salaries is probably the wisest way to go with getting money that you're owed for the money for the time that you're putting into your business. So it's really wise to pay yourself first. I try to tell that to entrepreneurs, like make sure you have a line for salaries for your monthly. So depending on your standard of living, like if you need $5,000 a month, make sure you always pay yourself first before anything else. Because yeah, obviously if this is your full-time thing, you want to make sure you're getting paid and you're not just pocketing everything. I hope that's I hope that's clear. Okay, so it looks like we're good on the question. So I'm just going to jump right back into this. And come on. Okay. There we go. So like I mentioned, this is a nice little overview of what I mentioned, gross profit or gross margin. Same thing, if you want to put in a percentage, you just divide it by the revenue, like I showed you. But again, I'm going to share this with you guys so you could play around with it, fill it in with your own stuff if you want. You could do whatever you want with it after. It's really just a template that I created for entrepreneurs when they kind of ask for help with their forecasting. So gross profit, sales revenue minus cost of sales. And then to get the percentage, you take the gross profit over the sales revenue. Net profit, basically all your income minus all your expenses. And then if you want to get the percentage on that, you just take that amount that you just created, the net profit, and you put it over the sales revenue. Okay. So like I showed you on the example, like how there was service and maintenance costs, so like business insurance, vehicle insurance, vehicle costs. So those are different costs of the company. So I want to give you a little background on what fixed and variable costs are. So fixed costs are costs that don't change month to month. So again, like those things that I mentioned that won't change is like telephone, that will always be $200, for example, or depending on how much usage you have, or like car payments will never change. So those things you can easily expect to cost something. So it won't change despite how much work you're putting into it. So say you don't do any sales on August, you're still going to have to pay rent. So those are fixed costs. And that's where the whole cash management side that I mentioned earlier comes into importance, where you know, okay, I have to make enough money in April to cover August potentially, because I'm not going to make any money in August, but I still have these fixed costs. Variable costs are costs that will change based on your business activity. So how much revenues you're making, for example. So forecasting for those costs will require more like sophisticated, more complicated efforts and what to expect. So like this nice little table shows us, so like fuel is a variable cost. So that'll change in the span of a month. Jars, if you use jars or whatever material you use for your product. So if you're building a bunch of inventory to prepare for December, because that's one of your busiest months, you're going to have a higher cost of sales in like September, basically, for your inventory, because you're preparing for that revenue that's coming in December, ideally. But I'm going to get into the cash relationship actually, and how forecasting can actually not be, I guess, the most accurate thing when it comes to your day-to-day, because again, cash management, it's one of the hardest things to manage, but it's one of the most important things to keep an eye on. So I'm just putting it here again so you guys can see it. So the gross margin, again, I am just taking the gross margin here over the revenue to show that, okay, I'm keeping 85 cents from every dollar that I spent. And then the net profit at the bottom, which basically shows all of the costs of operating the business, both the cost of goods sold and the actual operating expenses. So really, what are you walking away with? I'm walking away with 13% of all of my revenue, basically. That's what that's telling us here. Okay. So now the balance sheet. I'm going to try to kind of make this very simple. So basically, this is a statement that business owners don't typically take out often. So it's something that they do once and then they might update per year. But it's essential to include the statement when you're applying for loans or looking for investors. So basically, I'll just have an example here. I do. So the left side is actually, it shows all the assets of the business. So that includes cash, money that you didn't get yet, inventory, supplies, any prepaid stuff that you needed to put in that hasn't happened yet. Yeah, and then basically the right side is everything that costs to kind of acquire those assets, whether you put your own money in. So that's what this is for, the shareholder contribution. So you're the only shareholder, so you put $8 grand in there. And then the retained earnings is basically the money that the business kept, or it could be from debt. So you could have bought a bunch of inventory and used your 35K, for example, or building or equipment. So assets include inventory, cash, building, equipment, tools that you're planning to use for the years that you plan to operate. So this is the value of the company. So typically these balance, because obviously to acquire, to buy all these assets, there was a cost, whether it be from your own pocket or from the banker's pocket. I'm just going to go back here so I'm not finished it too much. Okay. So for startup, like I mentioned earlier, this is where you would put the cost of starting up, like I mentioned. So I need an equipment, for example. I'm going to research how much that equipment is going to cost. I'm going to put it on the asset side. How am I going to pay for it? The bank, for example, or I'm going to get these grants that I didn't get yet, but they're in the pipeline. It's going to happen maybe like 2 months down the road, or I'm going to put my own personal savings. So it's really just, again, balancing it through your own research that, okay, I need this to operate. This is how I'm planning to pay for it. Like I mentioned, the assets purchased could be either your own contribution, so your own investment, or through loans. So capital assets as well as inventory before sales. So vehicle, equipment, building, land, and obviously how you got those things. So I'm just going to show you guys again. So now I'm going to jump into the cash flow statement. We're almost done. I'm at slide 17 of 27. But a lot of it, the rest of it is just summaries basically. And actually, no, not summaries. I'm going to show you how to forecast. Sorry, guys. So cash flow statement. So cash coming in and cash going out. So this is your day-to-day. So this applies to your business as well as your personal. You need to answer, do you have enough cash to cover all your costs to operate? So it's the use of your cash. So this isn't a very, very, very simple cash flow statement. They could be very, very complicated if you allow it. So the cash flow statement is made simple for the example purposes for the main use of it. You can categorize these uses of cash in various ways in relation to investments. So if I need to buy new equipment, for example, assets, so inventory, equipment, office furniture, as well as operational expenses would typically go here too. So you kind of grab the money that's going out from your income statement and you can put it here as well. So it's really just showing how much money that actually just came out of your business. So expenses will go here. It's really important to keep in mind that the cash flow statement is really, really helpful in knowing what projections to look out for in regards to forecasting on a month-to-month basis. So the money from sales is not always collected in the same month that the sale is made. For example, okay, I sent an invoice out on December. So it's sitting in accounts receivable for, let's say, 2 months. So So you didn't actually get that money until 2 months. So really laying out when the actual cash comes in instead of when that I guess that invoice was sent out is really important, because again, you have your operating expenses, you have fixed costs, like I mentioned, that are going to happen regardless of how much money you come in. So managing like your collection calls, be like, okay, I sent this invoice out like 2 months ago, I need the money to cover my salaries, and we don't want that. So it's really important to manage your cash in a way that you're proactive, you're prepared for situations where maybe it's slower. So again, I kept it simple here, but if you want more background on cash flow statements, do a little research after this just to kind of see, okay, what else can I put into this? How can I manage it myself week to week? And they actually have really nice templates that you could probably find out there. So sometimes, so sometimes this results in inventory to prepare for higher expected revenues, like I mentioned. So you have to invest in a bunch of inventory 2 months before one of your busiest months. So really showing that, okay, I know for sure I'm going to put money in for inventory in April to prepare for the fall, for example. So again, the relationship with cash is really important. So the thing about forecasting, it doesn't really consider investments required to keep operating for your business. That's why the cash flow statement is really important, where you're like, okay, I'm going to need new equipment a year from now, making sure you have that accounted for, I guess, when you're applying. So this is another really important statement that lenders take into account. They're like, okay, this forecast looks awesome, but what is the use of cash? What is the owner's use of cash? Are they being smart with their money when they bring it in? Are they actually getting the revenue that month? Or again, it could come in 2 or 3 months after, which is worst case Ontario for that, but it happens. It's actually more obvious and more common than you would like to think. So in those cases, usually you go to your banker. I need help. I don't have enough cash to cover my salaries. Or you might have to go into your own personal savings, which is, again, not the best thing to happen. So making sure you manage your business cash is really important here. But again, like I mentioned, the purpose of the presentation, I'm keeping the cash flow and forecasting relationship really simple, but it's really important for you to understand the forecasting is an estimate. It's not an actual estimation of expected cash flow. So those forecasts require more complex calculations, especially if your products and services typically change and have like a pattern, but you can make your own basically. If you want to incorporate cash in your forecasting, go for it. But for the purposes of funding opportunities, keep it simple, like the example that I provided. Okay. So now that I've shown you the 3 main reports generated within the financial plan and projection section of the business plan, I'm going to drill down more specific on how to project them in the next 3 years. So essentially, I have this like growth rate formula, super easy. So I say it's easy, but I'm going to try to keep it, again, simple. So basically, you subtract the net sales from the prior period of that current period, and then you divide the result of the net sales of the prior period, multiply the result by 100 to get the percentage sales growth. So basically, I'm going to show you it, because I know it sounds like a lot. So this is, oh, let me get out of here. Oh my God. And that's why I hate this. There we go. Just bear with me. So this is typically what one looks like. So I basically have all the same numbers from that other example I gave you. And these are the columns I was talking about. So these are the next few years. So for the purpose of this, when I actually did this, it was 2022. So for this, I'll just show you. So that growth rate that I told you is at 12%. And I actually have it here to show you. Sorry, I'm jumping everywhere. So basically, it's taking the net sales of that 88,500 minus, so you're taking 2021's net sales and you're minusing it from the current year. So it's showing that difference. So basically it's 10,350. So that's the growth basically within the year. And then I basically just divide it to get that 12%. And that's what I actually apply it to this. So if I just double click that, I'm basically grabbing this and I'm timesing it by that growth rate that I told you. And then I'm adding it to that same amount. So it's actually just adding that 12%. So it's taking that 12% growth rate and including it there. And that's basically what I did for each one after, because I found what that growth rate was, assuming that you'll maintain that 12% growth rate in the next 3 years. You can add actually more percentages on that if you think you're going to actually increase your sales, but you need to explain how you're planning to increase those sales. Basically, you're like, okay, I already proved that I have a 12% growth rate because you had that historical information. If you don't, then you basically have to go and do, again, more research in a way that there's a lot of resources, like ACOA actually provides mock business plans in a way that you could be like, oh, this is how this business typically spends their money. And this is the expected growth rate, basically. But it's really important for you to do your own market research in a way that is related to your area and who you're planning to sell to. So for these things, again, I'm just keeping that 12%, again, all throughout this. So it's really just grabbing this column's results and just adding what that growth rate that you calculated from the previous year. If you think you're only going to make a 5% growth rate, instead of 0.12, which is 12%, you put 0.05. So really, like I mentioned in the other slides, forecasting is essentially an estimate that you have to basically prove how you're planning to grow your company. And if you have any expenses that will change, some of them don't. Like, as you can see here, that's not going to change because you're probably going to have the same repairs and maintenance. If you think you're going to have more, then increase it. So it's really just playing with your numbers on how you expect your business to grow. And again, it's all guesstimations. When it comes to this section, it's guesstimations, especially if you're a business that already has historical data. So you're just being like, okay, this is what I'm expecting my numbers to look like. But at the end of the day, it's all estimations. What lenders really want to know is how you handle your cash. Hope it's clear as mud. I'm just going to go back to the slide. Again, I'm going to show you how I got that growth rate, that 12%. So you're taking the previous year's net sales minus the current year's net sales. So that's like just your net sales. So like the sales revenue portion here. So I'll just show you the 88. So you see 88,500. I'm actually just grabbing that. Oh, I think I made up that number. So sorry, I made up that number because I don't have 2021. I took the 98,850. So that's the number I have here, right here. So that's your net sales. So that's the growth rate where I'm grabbing that from. See, I don't have the previous years here because I honestly just made up that number for the purpose of this. But that's essentially how you get that growth rate. So again, previous year minus that net sales. So that's net sales. So revenue minus your cost of goods sold. So the costs associated with creating your product, for example, to get that growth rate. Okay. And I'm just showing it here for example purposes. Again, I'm sharing all this templates with you so you can actually go in and play around with it yourself. So essentially, I'm just going to go back here. So essentially, I focus on the 12% growth rate. I had notes on this, I'm reading it. So it's basically only pertaining to the sales portion of the income statement. And the expected increases in those costs can be adjusted. Like I mentioned, if you only think it's going to be 5%, put the 5%. If you're only going to think it's 1%, or you don't even think it's going to change, you can keep it that way, but you have to explain why. So be prepared to explain why it's going to increase 12%. I put 12% because, again, that's historical. I'm proving to you that last year I made 88,500 and this year I'm making 98,850. I'm showing you that I made that $10,000 increase and I divided it over my sales and that's the percentage of growth that I got, I can explain that. But if you're saying I'm only getting 5%, you're going to have to explain why. So again, it's subject to change year for year. You can update your forecasting if you want in the year, the next year, basically, just because the more you do this, the more accurate it'll become. If you're a brand new business, it'll get better. But again, it's really important to explain that change and why it might increase or might decrease. So the cost items categorized, again, were made up for this use of this example. Each business has their own operational expenses. So they can categorize it however you want. So I have salaries, sales taxes, travel, that can change depending on what you categorize your costs to be. But essentially, like I mentioned, a COA actually has a really nice consumer report. They do all the market research. You can make a request for specific industries and what your business is there. And they actually give you really nice examples that you can work with when you're building your own. So that's actually in the notes of this slide. So if you want to check that out and want to make your own request with the COA, you can just follow that link that's in this slide, just so you guys know. Okay, so now what? I'm almost done. I'm just going to cover some things. This is actually really important because I have the banker's perspective. My partner is a commercial banker, and he told me to mention this as well because lenders do take this into account outside of financial projections. So essentially, they call it the 5 C's of credit. Some of you might have already heard it. So essentially, the first one's character. So this is credit history. So if you have poor credit history, it's good to start practicing on improving it. It's not something that's going to stay like that forever because honestly, you can improve it. I'm a perfect example of that. I had poor credit and I just worked at it. I kept paying it down and maybe adding an extra $100 to that loan amount, for example. So something that's not set in stone is something that you can actually build on. But unfortunately, credit history is something that lenders do look at, obviously. If you ever went for a line of credit application, they do a hard check. I think everyone here probably had that experience. So the next one is capacity. Or do I have that there? No, I don't. I'm going to have to add that. Sorry, guys. The next one is capacity. So basically, it's the applicant's debt to income. So how much debt you're actually taking on versus how much money you're actually bringing in. So say you have a higher debt than what your money's coming in, they want to see, oh, how, like, you're taking on too much debt to pay off another debt, for example. So they look at all of that. I'll add that in and I'll resend it. So just so it's there. Sorry, guys. Next is capital. So it's the amount of money that the applicant has. So basically, how much money do you have potentially to put as a down payment if you're buying a building, for example. Collateral is basically, do you have something that in case you can't pay your stuff, what can the bank take from you? So a lot of the times it could be a vehicle, could be a building, but it gets really complicated when it comes to on reserve stuff because they technically can't go repo your stuff on reserve. I've seen it happen, but they shouldn't. So the relationship with collateral is unique. So a lot of the times the banks actually have their own kind of indigenous application process. At least they should. I know New Brunswick is pretty behind when it comes to that. So I know in the bigger areas they should. If they don't, I would question it. I would literally just question the banker because a lot of times the bankers don't know. It would be a completely separate section of their division of the bank. So question it as much as you can because there should be different loan application, or not loan application, but how they deal with loans with people that live on reserve, because it will be different compared to non-indigenous people. It will be different, and we know it's going to be different. And lastly, we have conditions. So it's basically, why are you getting the loan, or the amount that you're requesting from the lender, and expected interest rate. So it's really just understanding what you're planning to use it for. So yeah, so lenders do use these 5 C's. I'm going to add that. Going to add that capacity in there, but as long as you're writing this down, then you're good. But I'm going to add it in. I'm going to resend it, as well as the templates I sent, or I've been showing you guys with the income statement and the ratios and all that fun stuff. So basically, yeah, they use the 5 C's to decide whether the loan applicant's eligible for credit. and to determine where you're at with interest rates, for example. So how much they're going to charge you for interest for taking that loan out. Hopefully low. And basically they help you determine how risky you are. So the likelihood of you repaying back that loan. So they just want to get their money back, essentially. In short, they just want to make sure that yeah, you can handle your money well. So hold on. So my key takeaways. So I walked you through what financial information is required to begin your projections, to access the funding opportunities that you're planning to access, whether it be for grants or business loans. I also introduced the 3 main reports included within the financial plan and projections portion of the business plan. So that's the income statement, balance sheet, and the cash flow statement. And then I showed you how to create those 3-year projections within your income statement based on either your already transactions, your historical stuff, or your estimated growth rates calculated through your industry research, your market research. So I plan to get 5%, but I need to explain how. And that's where you're going to kind of add in the market research section of your business plan into this section. So you're going to start seeing how these things relate to each other. And finally, I also discussed other important factors that potential lenders may consider when you apply for a grant, which are the 5 C's of credit. So the character, capital, collateral, and conditions. Is that 4? Oh my goodness. What is wrong with me? Pass these in there. You could tell I added that later. But now you know. So basically, it's important to know that forecasting is about making the best practical prediction you can do about any future business event. So sales, cost, timing. And it's not about being 100% right about these future events that might affect your cash flow. So it'll get better over time. So be gentle on yourself. Questions?
Awesome, Laura. Thank you. We have, I think, time for one question.
Oh God, sorry, guys.
No, you had lots of ground to cover, so don't even apologize.
Okay.
All right. Any questions before? I mean,
or whatever.
appreciate your summary.
I
really
a lot to cover. So the fact that you guys are still here,
yes, that's a win.
Oh, it's clear. Oh, that makes me happy because I know this could be a lot to take in, and I've had to walk this through with a few entrepreneurs. So thankfully, my past experience, it makes kind of talking about this stuff a lot easier. What stumps business owners when they're going through the process with investors? Last tipping. Okay. Oh, thank you. I think that was more of a comment. What stumps business owners? They are going through the process with investors. Yes. So it's really important for people to, yes, talk to an accountant about it, but make sure you understand where the numbers are coming from, because if you are going to investors, potential investors, so people outside of the bank or grant funders, they're going to really just hardball you with these questions on like, okay, how'd you get that ratio? And like, just making sure you did a bit of your homework before you kind of go face to face with investors, because they're hard hitters. They're potentially like getting a share of your company, like I mentioned earlier. So you're right. It's a good thing to keep in mind. So yeah, if there's no, do you have another thing that stumps the business? Do I have any other ones? Honestly, no. I feel like this is like the biggest thing that I get asked about is the financial side of this. And even with our entrepreneurs that go through the incubator, they struggle with this section really. And like, as much as we teach them about record keeping, it's a hard thing. It comes with practice. It's not the funnest thing to do. I know it's not. It's the reason why I'm not an accountant anymore. But it's not something that like it's fun to do, but it's honestly, it's so important for you to understand how you're doing, because how would you know if you're spending your own money into the business? You wouldn't know until you start doing a cash flow statement, for example. But yeah. There's no other questions, but
All right. I mean, you covered a lot of ground. You all will receive the presentation that she shared with us today and the templates, those good tools. Elsie will be sending it out to you. So, we're just, again, so honored that you could spend some time with us and teaching us. And you taught in a very, I want to learn my financial stuff from you from now on in a really fun, good way, like just down to earth. So thank you so much for the knowledge that you shared this afternoon, Laura, as it's been awesome. All right. Well, thank you everybody for joining us on today's Can Do Links to Learning. We hope to see you again and be well. Take care.
Audio, Namotas. See you guys.
Examaga.